Around the Bell with Scott Clemens, Chief Investment Strategist at Brown Brothers Harriman, along with Yahoo Finance's Jared Blikre. Guys, big day for Uber. But I got to start with you, Jared. What are you hearing from your traders on the floor?
Well, I want to talk about Pierre Giacchi. He is the Citadel DMM direct market maker, and I watched him open up Spotify. It took until about 12:30 p.m. that day. Little rumblings that it was a little bit long, but it was a direct listing. So he is in charge of basically matching all the orders and making sure that it opens up in an orderly fashion. The last thing that these guys want is for the underwriters to have to support the price if it dips below $45.
Yeah, we just had NYSE COO John Tuttle on. He said it may not open until the afternoon. Is that realistic?
Yeah, I've seen it happen that way. And with something this size, you have to match so many orders. And with an 80 to 90 billion dollar valuation, it could be 12:30, maybe even 1 p.m. This guy is very conservative. He's going to make sure he does it right.
Yeah, unenviable position. That's a tough position to be in.
He'll earn his money today.
Oh, you better believe it. So tell us, what are your feelings on, I know you don't get into the IPO market and you don't get on the ground level, and this is a risky one in many people's eyes, but just your thoughts on Uber going today.
Well, it's a great IPO. I think it's very different. I was listening to the earlier segment with John Tuttle. The big difference this time around versus 20 years ago, and it dates me to even say that, is that these are not new companies. Uber's a 10-year-old company versus 1998, 99, and the dot-com bubble. Those companies rushed to market without anything other than an idea on the back of an envelope and some unconventional valuation metrics. So these are real companies, there's no question. Uber's competing in a duopoly. It's on price. There are low barriers to entry. It's sort of a race to the bottom. So, and again, we're not participating in the IPO, but we'll watch and see how it plays out.
Now, Scott, you are a CFA, a chartered financial analyst. This IPO seems as though it's everything not what you learn in a textbook. So is it impossible to value?
It's impossible to value by traditional metrics, but if there's anything that Amazon has taught us, is that the market has become incredibly patient and appreciates the benefit of a network effect and scale. So the more patient you are, the idea that there are no earnings by a CFA or a GAAP standard, but you're building network, the market's been rather patient with that with Amazon. I think that's kind of a similar business model that a lot of other competitors like Lyft or like Uber are pursuing as well.
Yeah, and it's such a complex company. You look at the financials themselves, they total about 85 pages. You look at Lyft, which is a much more simple company, it's about 40 pages. There's so many different aspects to it, very difficult to model.
And if you look at the year leading up to this IPO, Uber lost $3.7 billion. Yet look at all the demand. So what are investors betting on here? Because they've even admitted they may never become profitable.
I think investors are betting on the idea that the simple core of the business model is replicable in other areas. Uber Eats and things of that nature.
Uber Freight.
Uber Freight. So what was originally just a ride-sharing model, or in Amazon's case, just let's sell books online, has legs, has a ripple effect to it. That's the bet that investors are making on the future.